Good afternoon. Welcome to MidCap Radar. I'm Sonal Bhutra. With me is Vivek Iyer, and it is a big fall that we're seeing across the board. Something that we've been discussing since morning, right? Mid-caps, those are the big casualty, 10% off from the highs. That's a big cut that we're seeing. But this is a correction that most of the market experts are saying was needed. It's a healthy correction after that stellar rally that we've seen.
Absolutely right. Yesterday, just post-market hours, we had the market masters, they too mentioned the fact that it's a healthy correction. They're hoping that with some further correction, they're expecting this particular wave of selling to actually subside, and that'll be something that the market will look forward to. But quite a lot lined up on the show. Let's start off with the top headlines. Stocks see a further dip, with mid-caps bearing the brunt of the selling. Auto, metal and consumer durables are the big losers, even if FMCG ekes out gains.
Dixon Tech more than doubles revenues in strong Q2 shows and ups its guidance for FY25 to 40,000 crore from just above 30,000 crore rupees earlier. But a sharp run-up in the stock this month invites profit-taking.
Radico Khaitan records a strong performance in prestige and above segment, with volumes increasing by over 12%. Company expects to deliver a double-digit premium volume growth in FY25.
Laurus Labs surges in trade despite weak performance in Q2 FY25. Management maintains their guidance, implying a strong second half of FY25. While Glenmark Life Sciences falls weak Q2, that weighs on the stock. Net profit falls 20%, but revenue declines 15%.
Strong performance in Q2 drives PNB Housing higher in trade. Their net profit saw a 23% jump year-on-year, while asset quality also improved. Disbursals come in at a multi-quarter high.
Okay, all right. So we've been discussing markets and how they've been falling since morning, and earnings, they are trickling in as well. But for now, if we talk about the markets in sector-specific moves, it's the FMCG space which really stands out. So the Nifty FMCG Index, that is doing really well in a market which is at the day's low, though even that has come off from the highs of the day. And we keep getting earnings for Atul Limited. It looks like a good set. It's a YOY increase, and that has come in after a long time. So the management commentary on how demand is looking like, we'll be watching out for that carefully. But mid-caps, that's definitely the focus point.
Definitely the theme. The banking pack today has taken it on the chin. IndusInd was weak, and along with that, a whole host of other banks like Bandhan too have taken it on the chin. But today, Hormaz is standing by the wall. He's decoded the fall in the mid-caps. Remember, mid-caps have fallen almost 10% from the September 24th peak, and Hormaz has all the data to analyze that particular fall.
Well, you just spoke about this a couple of days ago, and since then the mid-cap index has come off even more. So we just spoke about it when the mid-cap index was down 7%. Now it's down 10% from the peak, entering correction territory. The small-cap index too is down 8%, very close to correction territory as well. Remember, the mid-cap index topped out on the 26th of September last month, and so the small-cap index was a top on the 6th of September, slightly earlier. But we speak about the movers within the mid-cap index and the top losers there, and the more than 8 stocks are now down over 20%. And if you look at that, more than half the index, or 55 stocks, are seeing double-digit losses since the 24th of September when the mid-cap index made its record high. More than 30 stocks are seeing losses between 1 to 10%. And last time when we spoke about this, there were 20 stocks in the mid-cap index that had delivered positive returns. That number is down to 13. Now, which are the top losers then in the mid-cap index? Since then, there is Vodafone Idea, IGL, Cochin Shipyard, Suzlon, RVNL, all of the usual suspects. They're down over 20%. Vodafone Idea is now down almost 30% from in that last 1 month. But there are stocks that are down between 15 to 20% as well. Some significant names in there: Mahindra and Mahindra Finance, Escorts Kubota, Bandhan Bank. All of them are seeing losses of anywhere between 15 to 20%. The small cap index is no different. That stock index has now seen 16 stocks that are down over 20% from the 6th of September, from where the small cap index made a record high. Look at these names: Manappuram Finance, Raymond, ITI, Chennai Petro, and the list goes on because there are a lot more names in this list as well. Data Patterns, RBL Bank, HFCL, big names like Castrol, Intellect Design, PSUs like NBCC. All of these names have corrected anywhere between 20 to 30% from where the small cap index made a record high. So not a good looking screen. The mid-cap index has entered correction territory. The small cap index almost on the verge of that.
Okay, all right. Thank you so much, Hormaz, for joining us as always. So maybe the investors of such stocks, they are seeing a lot of pressure. But Hormaz, seems like you are in the Friday mode, and that continues to be the case. It's been a long week in terms of earnings. But thank you so much for joining us as always with that take. We'll slip into a short break now. Management of SBI Life Insurance joins us on the other side to discuss their Q2 numbers and the way forward.
Welcome back to MidCap Radar. As you can see on your screen, the numbers of Bharat Electronics, the latest entrant into the Nifty 50, has just delivered its results. The results on first take, appears to be above what the CNBC poll had indicated. Net profit coming in at a little over 1,090 crore versus the poll of close to 876 crore. Even the EBITDA as well as margins at this point of time appear to be above what the CNBC poll was anticipating. The stock, however, continues to sulk in trade. Street is yet to digest these numbers. Moving on, SBI Life delivered a soft set of Q2 earnings. The company's VNB margin contracted to 26.9%, while its new business premium also fell 13% on a year-on-year basis. APE growth for the company, however, came in line with estimates. My colleague Yash Jain caught up with Amit Jingran, the MD and CEO at SBI Life Insurance, to discuss their Q2 earnings as well as outlook for the second half of the year. Listen in.
If we talk about the APE growth, I will again say that the first year growth at 9% was a little below our expectation, and in the second half we have given that for the full year we would like to close the year with a 15% growth in the individual segment.
Okay.
The pain that is coming from is basically on the group business front. And that is as per our strategy, because the yields in the market have fallen down during the first half year. And some of the competitors are quoting very strong rates. I would emphasize that we will not be booking any business which is profit negative for the company.
If 15% is the growth that you're guiding for individual APE, at this point of time at least, with that 15% individual APE growth, could the total APE growth be about 200 basis points lower, because that's been the difference for total APE for FY25?
It will depend on how the group business pans out in the second half also, the total APE number.
What you had guided for as far as VNB growth is concerned is a 15% growth on the VNB side. What I want to understand is that do you still stick to that VNB guidance of 15% growth for FY25? Because then you have a very, very tall ask in the second half with just about 3% growth in your hands or 2% growth in your hands in the first half. What can we expect in terms of the VNB growth for FY25 and H2?
So VNB growth, as you already said, depends a lot on the product mix also. We are seeing that ULIPs are flavor of the market.
Correct.
The entire industry, the growth is coming basically from ULIP. In the second half, we expect good growth numbers to come from the protection product, which will be margin accretive also.
Correct.
So based on that, we will definitely be improving on the VONB growth also.
Okay. And that could be in the range of 13 to 15%. Is that estimation correct?
It should, yeah.
Okay. Protection and annuity from 11 and 15%. Could we get an increment of about 500 basis points in terms of the share simply in the current financial year with the product launches that are lined up at least? Not a specific number, but a 300 to 500 basis points addition in the share of protection and annuity. Is that possible?
Protection in the IRP basis in the first half was around 8% on the individual side. And that was because we were going to launch new products, and that is why we were slightly slow on the existing products.
Correct.
These products have been launched in the last quarter at the towards fag end. And we are getting some very good numbers, like the product on the YONO platform has already clocked more than 33,000 policies in less than a month. So although the premium here is lower, but we expect to play on the volumes and the large customer base of the State Bank as well as on the YONO platform.
Correct.
We expect this number to substantially go up.
Under what level on ULIP would you be comfortable? So HDFC Life, one of your competitors, very clearly said sub 30% on ULIP and will be comfortable to continue under that bracket. They've reached about under 35%, sub 30% they'll be comfortable. What would be that number for you that you'd be comfortable and happy with?
We have always been a ULIP heavy company for last 4-5 years.
Correct.
So we are, and even that our margin are much higher than our competitors. That is because of the unique kind of cost structure and our expenses structure, our commission structure. There are so many things at play which lead to better margins to SBI Life despite selling a higher number of ULIP. Okay. So I am not as uncomfortable as maybe our competitors are.
What should be the new guidance that the street would work with as far as VNB margin is concerned? And how confident do you look at this point of time to be able to achieve that?
I think we should be able to maintain that 26-27% kind of margin with a positive bias.
Okay, so down about 100 basis points from the earlier guided, but 26 to 27% is the comfortable range that you'll be able to achieve. Your total protection premium in the first half was down about 14%, where individual premium was down 25% and group premium was down about 11%. Let's single this out on one side. Let's look at H2. Growth, yes or no? Positive growth. If yes, then what is the number that you're looking at on the protection side, and under that individual and group?
Positive growth definitely should come on the back of these products, and on the credit life side also, like you were talking about group. Yes. Credit life, again, we have simplified the processes, eased the underwriting standards, and a much higher sum assured can also be taken without medicals and all. So that limit is also being increased. So there should be some accretion, positive growth coming on the credit life front also. So I would not put a number to the growth, but definitely a positive growth in the second half.
But your protection premium, as I said, in the first half is down 14%, annuity premium is down 17%. Would the growth be enough to take the overall FY25 numbers in the positive territory?
Yes, protection, I am very sure that it will be positive.
Right, that is the word coming in from SBI Life. By the way, HPCL's numbers, they are a big miss versus what the street was working with. The improvement was expected to be sharp on a sequential basis, but that is something that has not happened this time around. And this is led by the refining segment. The calculated GRMs this time around have come in at around $3 or $3.2 per barrel. The expectation was around $5 per barrel. So definitely a miss from the refining bit. Marketing margins is something that the company does not provide or report immediately. So that is something we'll get to know on the conference call. Yes, there is an improvement on margins on a quarter-on-quarter basis, but it is not as much as the street was working with. In fact, it's half of what the street was working with, and HPCL that saw the weakest numbers in quarter 1. So the expectation was that they will see the sharpest improvement, but that hasn't happened, and that's why that sharp knock on the stock that we're seeing right now, down around 6%.
Well, what a knock on the stock. Half of what you were anticipating is what the profitability has come at. I think the street will wait for the marketing margins as well. Time now for a short break. Pastor Babu Ramchandran from Suryodaya Small Finance Bank joins us on the other side to discuss their Q2 numbers and the way forward.
Welcome back. You're still tuned into MidCap Radar. Suryodaya Small Finance Bank, that is the next management of the show, reported a sequentially weak quarter. Ramchandran, MD and CEO, the MD and CEO of Suryodaya Small Finance Bank is joining in now. Mr. Ramchandran, good afternoon. Thank you so much for joining in today. You know, provisions were high in this quarter while operating profits declined on a quarter-on-quarter basis. So wanted to understand, how do you see provisions going ahead, and what is the guidance on credit costs for second half of FY25?
Yeah, good afternoon. Yes, there was a spike in terms of the provision that we made because of the microfinance challenging environment which we had in Q2. which seems to be stabilizing as we speak in terms of September as well as in terms of October. It was higher by 16 crores. Our income was lower because of the PSLC income, which is seasonal and happens in the first quarter. So these had an impact. And what we really see is in terms of tapering off in terms of credit cost, closer to probably, we'll have the same as we had in Q2 for Q3 almost, but Q4 should be much better as we see improvement, specifically in the microfinance segment, stabilizing.
So Ramchandran, clearly, like other lenders, you too have seen the pain, from that particular space, the MFI space. Provisions have spiked up. Outlook on provisions going forward, and also, at the start of the year, you had guided for an advances growth in the range of 30 to 35% and deposit growth in the range of 40 to 45%. Where are you tweaking that guidance to?
We are still on track in terms of deposit guidance of closer to around 40%. In terms of asset, as we speak, even if we continue the current momentum, we'll be closer to around 27, 28%. So inching towards the lower end of the guidance is where we are. And as far as the slippages are concerned, our entire inclusive finance portfolio, around 98% of it, is covered under CGFMU, which we started from the financial year FY23. So our net NPA is 70 crores, but the claims under CGFMU, which is eligible, which we'll get in the Q1 of next year, is approximately around 140 crores. So it's much more than the net NPA we are carrying. So there is a cyclicality in microfinance industry which happens. The reasons could be varied, but we did really see that happening, and the CGFMU is a good cover, specifically for encouraging micro entrepreneurs, and our entire IF portfolio is covered under that.
Okay, so let's talk about the unsecured loans part as well. Usually they are not recoverable. So what were the write-offs this quarter, and how do you think that would impact the different ratios going forward?
So we're still on track in terms of GNPA less than 3%. We're currently around 2.9. Probably maintain that a little lower towards the end of the year. We do not see the slippages increasing in the microfinance sector. Q2 was really, really challenging across the board, across the states. It was not one or two specific states. Some states were more deeply impacted, probably in the northern states, which we are not present. But even among the states which we are present, Gujarat did see a substantial increase in slippages, which we didn't ever see it in the past couple of years. But we see that kind of 127, 130 crores. We would see that almost at the same range for Q3 and taper off quite substantially with Q4.
Mr. Ramchandran, once again, just want a few numbers from you. In terms of NIMs, you had guided in the range of 9.5 to 9.7%. GNPA, you had targeted to keep it less than 2.5%. ROAs were expected to be in the range of 2.2 to 2.3%. Post Q2, where are you tweaking these numbers to? And also, have collections improved Q3 onwards in the MFI space?
So we are in the first month of Q3, but what we see in the first 25 days, there is an improvement. There is an improvement. For instance, our current bucket collection efficiency used to be at 99.5, tapered off month on month for the last 6 months to closer to around 97.5 in September. But the same 97.5 was also in August, so the deterioration stopped in the month of September. As we speak, we really see probably 100 basis points increase for the month of November. And if it were to stabilize and improve a little higher, because the slippages which has to happen probably has happened in the first 6 months, we will not see a similar slippage for customers who have managed through all these challenges. So hopefully the slippage will come down. On the guidance front, we are likely to be towards the lower end of all the guidances that we are given, except for probably deposits, which will be probably in the same range as 40 to 45%.
Two more numbers, cost to income, you had guided in the range of 57 to 58%. You've mentioned in your PPT that, you are expecting ROEs to be impacted. Earlier range was 14 to 16%. So where does that come down to? Is it at the lower end?
In terms of our ROE, will be closer to around 2%. But this is without taking into consideration the refund the reimbursement that we'll get under CGFMU, which we are not accounting while we are accounting for the expenses. Closer to 17 crores is what we paid in Q2, which is towards the CGFMU insurance coverage. But the benefit of that will flow for us only in the Q1. So around 2% is where we are. Likely that the return on equity will be closer to around 13.5%, 14%.
All right. Okay. Thank you so much, sir, for joining in today and giving us the details of what went by in the quarter gone by, and most importantly, the outlook going forward. With that, we'll do one thing. We'll take your leave on this edition of MidCap Radar. Stay tuned. Closing bell when we return.